a big merger rocked the golf world yesterday after Saudi-backed LIV Golf and the PGA Tour announced their newly formed identity to unify golf, sending shares of stocks like Topgolf Callaway brands higher and ultimately reducing competition in the world of professional golf. But what does this mean for investors and how they view market competition? So back with us is David Mazza, who is the Roundhill Investments Chief Strategy Officer here. And some of the crux of this was kind of applying this type of merger and essentially now golf monopoly, if you're looking across some of the different leagues and how they've come together. Where there once was competition, there is no more. So that's good for, I guess, everybody around the sport in some fashion or another. There are a lot of questions that still linger around it. But how do we apply that to what already exists in the business world too, where when there is less competition and that competition falls out, how does that benefit some of the other players that investors might look at?
Yeah, no, I think this is interesting. Yeah, we could probably spend, and I'm sure there will be networks spending hours and days talking about this merger because there's a lot of juice behind it, right? And I'm sure we'll be hearing more about it. But to apply it to markets, and I know you all were speaking about that today in the newsletter. It goes back to the thesis that I've been thinking about, this that I mentioned a moment ago, this haves and have-nots, is that we are seeing either through mergers or just general sort of monopolies that there is a smaller and smaller handful of companies that are gobbling up everything. We know that there used to be significantly more publicly traded companies to begin with. The number of companies has gone down by thousands over recent decades. Many of those probably were smaller, unprofitable companies that people shouldn't have been touching anyway, but that was a way for companies to raise capital. Now, you go to venture capital, private equity, you don't necessarily have to go to the public markets. And when we see a company like, whether it's Alphabet, Apple, Microsoft, and we can name a handful more, they touch so many different areas. And we forget sometimes, I think, that these companies own other companies. Right? They used to be standalones, and now they're owned by someone else.
Right.
And there's benefits to that, right? So you can have synergies with that service model. And again, to me, that's one of the reasons why. And it's always challenging to say this time is different, but there has been some structural change that has occurred, right? So if we compare this environment to the tech bubble or other periods, what's different now is that the largest companies are extremely profitable. They have extremely high revenues, and they're growing those revenues often from smaller portions of smaller investments that they own, whether it's Alphabet and YouTube. That's a prime example. And you could go on, Metaverse and Instagram, right? We could go through a laundry list of these, but there's some truth to all of this, that these kind of single companies have all these different platforms. And the same's happening actually in markets like China too, which is interesting.
Well, and the other interesting part is, whereas in past eras, even though this administration is seen as being fairly active on the antitrust front, when you're talking about these largest companies, there's more rhetoric than action. In other words, there don't seem to be real concrete regulatory threats to the absolute domination of those companies, right?
Yeah, no, I think there's a lot of chatter. I think there was expectations heading into this administration that there would be, some breakup fears or other things of that nature. I think there's been a crypto crackdown, as we know.
Well, and they've been challenging pending deals, right?
Correct, exactly.
But not things that have necessarily already happened.
Yeah, and so when these mergers happened 10 years ago, 5 years ago, now we're actually just beginning to see how they're playing out. And so it is difficult to go in and start saying we're going to break companies up. What I think is interesting, that's not a ton of attention is being paid on, is just how different the regulatory environment is with the US and with Europe, especially around things like social media and now generative AI. And that's one of the reasons why we're seeing companies voluntarily put their CEOs and other C-suite executives in front of Congress and saying, regulate us, please, because you'd prefer to be regulated on your home turf than you would necessarily in Europe, where you have less influence and control.
Yeah, or as we saw, GDPR.
GDPR, yeah.
Thank you, and how that started in Europe and then came here.
Mm-hmm.
So they got a little practice before they had to enact it all here in the U.S. Dave, great to see you. Thanks for coming to visit us. David Mazza, Roundhill Investments Chief Strategy Officer. Appreciate your time this morning.